So welcome everyone, good morning, and welcome to the second of the two financial internal controls workshops titled Compliance with Funding Contracts and Regulators. My name is Sabrina Dimitra, and I'm AMSA Settlement and Integration Program Manager, and I'll be facilitating today's workshop. I'd like to acknowledge the Indigenous land that we're located on today. And as a provincial umbrella association, AMSA acknowledges that BC is on the unceded homelands of the First Nations who have stewarded this land since time immemorial. We recognize the privilege that we have as settlers on this land and acknowledge that AMSA's operations is located on the unceded traditional territories of the Musqueam, Squamish, and Tsleil-Waututh First Nations. As well, I would like to acknowledge and recognize that I am joining you today from the unceded traditional territories of the Kwantlen, Katzie, and Stolo First Nations. And I'd like to introduce our speaker for today, Gordon Hawley. Gordon is the co-founder and president and CEO of Humanity Financial Management. Humanity Financial Management works exclusively with social purpose organizations to help them build internal financial capacity. I'll let Gordon introduce himself further and to take over with our content for today. Welcome, Gordon.
Wonderful. Thanks, Sabrina. So welcome, everybody, and good morning. As Sabrina mentioned, I'm co-founder and president and CEO of Humanity Financial Management. We're a CPA firm in West Vancouver, BC. We've got about 25 employees, and I've been a CPA CA for about 30 years, since 1991. And I've got roughly about 45 years of cumulative board experience, mostly as treasurer. So I spent a fair bit of time on boards, small local boards, medium-sized boards, and some national boards. I'm currently on the board of Community Foundations of Canada and the West Vancouver Foundation. And Humanity Financial Management is kind of a unique organization. We're not a traditional accounting firm. We don't do audits, review engagements on financial statements or tax returns. We work specifically with social purpose organizations, and we leverage our financial expertise to help them build strong internal financial systems and financial capacity. So we work with organizations on everything from financial transaction management systems to bookkeeping and accounting systems, budgeting and reporting systems, and financial governance systems. And our topic today around internal controls, specifically the first part of we'll get into the content in a minute. Anyway, this is the kind of work we do. That we're not a traditional firm, and there are, to the best of my knowledge, very few, if any, firms like us across the country. We're also one of two certified B Corp accounting firms in Canada. We're currently the largest certified B Corp. And B Corps are interesting organization. Once you've been certified as a B Corp, we are certified that we balance profit and other goals. So we have goals with respect to the value that we provide to customers, the career paths and value that we provide to our team members and to our community. We're required to have a light touch on the environment and select our suppliers according to very specific criteria. So it's using business as a force for good, and that's one of the things that differentiates us from many of the most of the CPA firms in Canada. And this is just a quick snapshot of some of the great organizations that we work with. So in today's session, in Tuesday's session, we talked about an overview of financial risks and controls and effective financial governance. This was at a very high level and sort of provided the big picture for internal controls and financial governance. And today we're going to be getting into much more detail. Specifically, we're going to be talking about, in the first half, compliance with funding contracts, specifically with Immigration, Refugee and Citizenship Canada, or IRCC funding contracts. And then we're going to talk about compliance with regulators, including the CRA. So the first thing I want to note before we get started is that I am not an expert in IRCC funding contracts. I've probably read, I have read hundreds and hundreds of funding contracts from many different organizations. I have read through a copy of an IRCC funding agreement, so I'm familiar with it. But if there are people from the IRCC on this call and I make any errors or omissions with respect to talking about the IRCC contracts, please feel free to correct me. But we've used that as an example to try and identify some of the areas where AMSA organizations have previously been making mistakes or not complying with the IRCC funding contract. And with that, I'm going to get into the content. So we're going to cover several topics related to funding contracts. First of all, why we care about funding contracts, why they are important to our organizations. We're going to talk about some of the common pitfalls in administering funding contracts, some general best practices in administering funding contracts, and then some specific best practices as it relates to the IRCC contracts. Now, from a compliance point of view, a funding contract is a legal agreement that binds the organization to perform various activities for various costs. But when you step away from thinking about this as a legal obligation, funding contracts are critical to an organization's success. The funds we get are used to deliver programs that advance our missions and our purpose, and enabling us to have a greater impact on the communities that we serve. And success on one contract can lead to additional contracts and the ability to serve more people. And after the initial celebration of being awarded a funding contract, it's important to really take time to understand the contract. Contracts can be written in lots of jargon and can be confusing. So make sure you take the time to get the help where and when you need it so that you understand what you're committing to as an organization. A great way to start is with your funder and spending time with them to go over the clauses that may be confusing. In some cases, it may be entirely appropriate to consult your lawyer. And make sure you're clear on activities that you must deliver, deadlines and delivery dates, requirements and/or restrictions, and reporting timelines. You can set up work-back plans and understand your dependencies so that you can ensure you meet your deadlines. Your team will be busy with program delivery, so any opportunity to chip away at the things in advance of the deadlines is helpful. And just to press home one of the points you made, contracts are written by lawyers and in many cases need to be interpreted by people who are familiar with the contracts. They can be complex and may not be written with understandability as their prime objective. They're meant to protect the assets and reputations, mostly of the funder. So it's critical to work side by side with your funder to ensure that you both have the same understanding of every clause in the contract. And funders mostly really appreciate being asked for clarity because it gives them the confidence that complying with the contract is important to you because you're taking the time to ask the questions. Future funding opportunities for your organization are directly related to your ability to meet funder contract requirements. Your reputation and credibility is connected to your ability to achieve outcomes in alignment to the agreement that you've made with your funder contract. Your funder may require you to repay funds that were spent on activities and expenses that they didn't approve. If you don't understand your obligations up front, you will likely need to do a bunch of rework to fix things that could have been done right the first time. So it's really, really important to understand your obligations under the contract, not just the program outcomes, but also for financial reporting and using funds on eligible expenses under the contract. In fact, in paragraph 8 of the IRCC contract I saw where it talks about default, there are two things in here I really wanted to bring to your attention. And the first is that the recipient, and this is organizations that would be considered in default of the agreement. So this is a part of the definition of what does it mean to be in default. And the first is the recipient is in breach of the performance of or compliance with any term or condition or obligation on its part to be observed or performed, or the recipient has submitted false, misleading, or inaccurate information to the department. And I don't know if you've ever heard the term of walk softly and carry a big stick. Well, that's what funders often do. They build clauses into the contract that give them the ability to terminate the contract and the funding, but they usually try and work with fundees to educate and assist them in complying with the contract. And this is, I think, what IRCC is doing by sponsoring webinars like these on internal controls. However, we have seen funders pull the plug if they get the sense that the fundee doesn't care about compliance, or if they demonstrate a lack of sincere interest in complying. So if you want good relationships and continued funding with your funders, make sure you take contract compliance seriously. So some of the consequences of non-compliance. Well, first of all, you'll likely lose the goodwill and a good relationship with your funder, and that's never a good thing. You can also lose future funding opportunities. And specifically in the case of the IRCC contract, you can have your current funding suspended, or you can have your current funding terminated. Clearly, working earnestly with your funders to ensure that you comply with funding contracts is always in your best interest and critically important to your organization. And also know that funders talk to each other, and that more and more funders are doing reference checks on grantees to find out how easy they are to work with, how interested they are in compliance, and how well they're able to demonstrate the impact on the communities they serve. So upsetting one funder can put your organization in a downward spiral with multiple funders. So again, the contract compliance is extremely important for all organizations. And funder contracts are successfully delivered through people, processes, and technology and systems. Think of these as three levers. All three levers need to work together to ensure that you're able to deliver on a funder contract. Your teams are focused on delivering high-quality programming. And while this should always be their top priority, they'll benefit from some basic working knowledge related to the contract. They need to know what the boundaries are and how to work within them. Take the time to orient accountable employees to the terms and conditions of the contract. Make sure everyone's on the same page. Check for understanding along the way by asking your team questions on where you can get a sense of their interpretation of the key requirements. It's obviously really important to ensure that the team is clear on funder policies and guidelines. Their policies and guidelines may be different than other funders' policies and guidelines. So once again, check for clarity and ensure that all questions have been addressed. So here's a specific example in the IRCC contract, and it talks about using specific mileage rates as identified by the Treasury Board of Canada. And IRCC finds that some organizations don't use these rates. And I think these rates are adjusted every 6 months. So you want to stop on changes in rates. And so watch your contract dates. Rates can change in the middle of a contract. And this is a great example of how different expense guidelines may guide a funder. These mileage rates may differ from other funders, and make sure you aren't making assumptions about policies and guidelines. You'll also want to make sure that you've got appropriate systems in place to track and report program mileage accurately and are maintaining documentation to support your mileage claims. And make sure that the team doesn't make assumptions around processes. As an example, funders likely have an established process for how to redistribute funds or hire subcontractors, or to make changes to approve program expenses. And at the same time, don't assume that the processes described can't be refined. Perhaps you have an idea that you want to explore. As an example, perhaps you want to propose a change to the planned result or eligible costs. But you need to make sure that you discuss these ideas with the funder and get their approval in writing prior to taking any different action, so that there's a record of the variance and the approval. Remember that your funder wants your program to be successful and wants you to achieve your intended results. If you have ideas about how to achieve better results and outcomes, they'll likely be open to exploring these ideas with you. It's common to see organizations work with manual processes that require spreadsheets and people entering and re-entering data to produce reports that tell folks where they are in their approved budgets with various funders. But wherever possible, we encourage organizations to design more effective bookkeeping and accounting and technology systems so that you reduce your dependency on people to do this work. By leveraging your accounting systems and designing them to do more of the work for you, you gain efficiency and reduce risks associated with input errors. and are able to generate timely financial reports that help people make decisions around how and where to spend on their programs. And don't forget your subcontractors. As outlined in Schedule 4, you have a fiduciary responsibility over these redistributed funds. If you're outsourcing any parts of the program work to others, they need to become sub-agreement holders, and you need to have a legal contract in place that binds them to abide by the same terms and conditions as you are required to abide by under the contract. Under the IRCC contract, you're responsible for making sure that they're holding up their agreements under the contract, and you're ultimately responsible for all of their work. So make sure that they fully meet any contractual requirements, such as the requirements that will be outlined again in Schedule 4 of your IRCC contracts, and that they are providing you with the appropriate documentation of their permitted spending. And just some best practices for managing funder contracts. Obviously, make sure you read and understand the contract, and in particular, the contract budgets and financial terms. And there are usually a number of sections that are specifically talk about the financials and about financial reporting and financial processes. So it's really important to read those periodically, refamiliarize yourself with them. Look for spending restrictions, administrative overhead restrictions, and definitions of eligible and ineligible expenses. To ensure you're able to successfully implement your funder contract, you have the impact of this contract to consider and the effect it will have on your people, processes, and technology. As in any change event, it's important to first build an awareness of the understanding of the change you want to have on the communities you serve. Talk about the funder contract with your team and talk about why this contract is important to your organization and what it's going to allow you to do and the impact you'll be able to have as a result of that contract. Remember that what you say might not be what your employees hear. You may need to repeat key messages and reinforce key points. Once people are aware and understand the contract, explore what the impact of these changes are. Invite team feedback around the different stakeholders impacted by the change, what the nature of the change is, and how best to address the change. Your team might suggest that you do some training, recommend some changes to how your internal processes work, etc. And as your team makes recommendations on how the organization can better meet funding requirements, take action. In most cases, the action is around building knowledge and capability. In some cases, your action may require some modification to your internal processes or to your accounting systems. We'll talk more about some of the best practices related to improving your accounting systems in just a moment. And finally, it's important to inspect what you expect. Monitor and review the work. Check to ensure that what you expect to be done is done in the way that it's required to be done. Take the time to acknowledge and celebrate successes when things are being completed well, and also take the time to share lessons learned when things need to be improved. There's really two parts to understanding a contract. You need to understand what is required of you, and you need to understand how you will fulfill that responsibility. As various different people perform the what and how, it means that different people must be oriented to the contract and be responsible for its execution. Some specific enhancements to your accounting systems include, for example, using separate departments, funds, or classes for spending related to each different contribution agreement. This allows you to report back on the revenue and expenses of that specific agreement to your funders and make sure that you don't overclaim any specific expenses between your various funders and that you're capturing all of the relevant expenses between the funders. You want to make sure you're claiming expenses like administrative overhead, generally at consistent amounts throughout the contract, instead of trying to account for each photocopy or paperclip or pen you use. But for program delivery expenses, they must be separately identified from total organizational expenses, and you need to track them on an ongoing basis and report on them specifically. And you want to build funder confidence through transparent, consistent presentation of the organization's financial circumstances throughout all stages of the application, budgeting, and financial reporting processes. Some problem areas that have been identified are misstating the organization's financial circumstances during applications for advanced funding, or claiming administrative rates, for example, in excess of the appropriate rate allowed for by the contract. I think with the IRCC contracts, the administrative rate, the maximum allowed is 15%. But again, make sure you read the contract, understand what the administrative rate is, and don't Don't try and claim anything in excess of that rate. The funder is going to check. Accurate bookkeeping sets you up to produce timely and useful reports. It's best practice for your controller to oversee the work of the bookkeeper, specifically to review and ensure the accuracy so the controller can produce the reports that help organizational leaders and program leads with knowing where things are at. Some errors to avoid, things like incorrect amounts being entered into the GL. These should be reviewed and reconciled. Claiming prepaid expenses before the organization has received the benefits it's contracted for. Claiming expenses in the wrong cost category included in the budget, or things like including repairs and maintenance as being incorrectly classified as capital. And finally, claiming expenses like mileage at higher rates than permitted by Schedule 2. And while the description of eligible costs outlines your maximum entitlement, it's possible that you might not be able to fully spend what has been authorized. This can happen when you put forward a proposal where your program hasn't been fully designed or budgeted for. In these cases, your initial vision for a program may differ from what can be practically delivered, and the funds that you initially requested might not be usable. So make sure you work with the IRCC and other funders to explore how these funds can be reallocated prior to taking any action to avoid the risk associated with the spending being denied. And here are some examples of inappropriate practices that aren't in alignment with most funding contracts, or specifically the IRCC funding contract. Viewing Schedule 2 or the detailed budget as an actual entitlement and claiming those amounts that are in the budget instead of viewing those documents as outlines of the permitted types and maximum amounts of allowable claims. You can only claim what you actually spent on the eligible expenses. Another example is incurring significant expending on issues not covered by Schedule 2 because the organization is proceeding to do what it thinks best for its own client. You want to make sure that the expenses you're spending are in alignment with the program goals of the contract and that you have IRCC's permission to spend the money and that they're eligible expenditures. You don't want to view the amounts in the budget or Schedule 2 as absolute rights and recharacterize the nature of certain expenses or inappropriately manipulating their recognition in order to use up 100% of the amounts in the budget. You want to be reporting truthfully. You want to only be including eligible expenses in your claims, and you don't want to be manipulating your claims to try and fit within the budget categories. Again, this goes to building transparency and accountability with the funder. It's building your relationship with the funder. You want to make sure that your financial reporting is accurate and complete. Now, the IRCC has provided an internal controls cover letter, and the funding recipient must take on the role of verifying that all 4 points listed near the beginning of the internal controls cover letter are taken care of. So you need to confirm that the program objectives are being met. You need to validate information submitted through financial reports. You need to verify the eligibility of expenditures claimed and assess internal controls related to the organizational management of each contribution agreement. Some specific challenges that have been observed, specifically in the case of IRCC, the failure to execute the contracts with third parties during funding redistributions, which fully meet the demands of Schedule 4, and failure to fulfill the necessary fiduciary role over redistributed funds or funds spent with contractors, including providing clear documentation of permitted spending by the third party, receiving appropriate claims from the third party, and asserting a regular audit review over the redistributee. So really, really important. Schedule 4 outlines all of the rules that you need to abide by with respect to utilizing subcontractors in delivering programs. And I think they refer to it as redistributing funds. You want to make sure that you dot your I's, you cross your T's, you follow the rules. And ultimately, your organization is responsible for making sure that the subcontractor, both that you have a legal agreement in place with the subcontractor, that make sure that they abide by all the rules that you're required to abide by, and also that they are actually abiding by those rules. So you have a fiduciary role to oversee their work and make sure that they're abiding by the contract. And your controller should be able to provide training so that your team has the necessary knowledge to be able to work in alignment with your funding contract. And teams should all be applying the knowledge consistently. Insufficient understanding of the difference between administrative costs, like CEO salary or CEO and receptionist office space, et cetera, and those eligible program costs that directly support program delivery. Some areas of concern that have been identified: understanding benefit needs should be determined based on rates in effect plus anticipated average uptake. Like, for example, CPP and EI rates should never be claimed and included in the detailed budget at rates higher than those set by the government for the year. And average claims for discretionary benefits should be roughly the same percentage of base salary as claimed in the detailed budget projections. And keep in mind that the funders will usually be checking these, so make sure that they're in alignment with the regulatory environment, the amount set by the CRA, and in alignment with the budgets you submitted. So some best practices: obviously engage with the IRCC as partners. The IRCC wants the same things as you do. As partners, they want to see your organization be successful and deliver the programs and achieve the intended impacts that you both want. But you want to check in periodically, ask for clarity when it's required, and provide feedback on what's working for you and what can be done differently to improve. Transparent and accountable relationships between funders and fundees go a long way toward great relationships and enable organizations to have significant positive impact on the communities that they serve. And remember to inspect what you expect. Check to ensure that things are being done properly, both with you and your subcontractors, and provide feedback, coaching, and training to your internal team members as required. And keep in mind that staff team members assigned to track contract spending and prepare claims must have sufficient levels of expertise, training, and supervision. This is absolutely critical because it's very difficult to stay in compliance with funding contracts if your teams don't have sufficient expertise, training, and supervision. And it's the training and supervision that are often lacking. So take a look at your existing people, make sure that they understand the contracts, and make sure that they have the expertise, training, and supervision. They also have to have a sufficient understanding and adherence to written IRCC policies surrounding entitlements. Contract terms are about 13 pages, and the budget submission guidance is detailed in Schedule 2 with a description of eligible costs. I think there's 6 pages for that in the contract that I saw. And then Schedule 4 has the supplementary terms and conditions, including the redistribution of funding. These two particular schedules, Schedule 2 and 4, are critically important in IRCC contracts. Why don't we take a quick time now to answer questions related to the slides we've done so far. And keeping in mind, I'm not an expert in IRCC funding contracts, but I'd be happy to try and answer any general questions that people have.
Yes, and it's some of the questions are a little bit more in general in nature. They're not like specific around details in the IRCC contract. One question around was asking if you can confirm, that they just wanted to double check that they heard correctly, that you really recommend that all staff, including frontline staff, contractors, receive training on compliance with funding contracts. And if yes, do you have any recommendations of what type of training or where to access that training?
Well, I think specifically, absolutely. With respect to funding contracts in general, any staff that are operating under the contract and whose salaries are going to be paid for by the contract should understand what the required deliverables are under the contract, and they should have a sense of the costs, the eligible costs, and the ineligible costs. So yeah, I think it's absolutely imperative that certainly the people making decisions, but also the people that are on the front lines, so that they're aware of what the requirements of the funding contracts are, what the deliverables are, and how they might work best to deliver those deliverables. And sorry, what was the second part of the question?
The second part is there any specific training that you would recommend for them to receive?
You know, there is some training available with respect to project management generally. So if you've got program managers that are implementing these contracts, those might be good courses for them to take. I think Humentum offers a project management for program managers. So that's one organization to check out. But otherwise, I think mostly it's internal training. It's training by the program managers that are responsible for delivering the contract, identifying what the relevant pieces of the contract are that should be communicated to, and that specific staff should be responsible for delivering to.
Perfect. Thank you, Gordon. The second question that I received is, do you have any best practices or recommendations around managing multiple different funding contracts? So that was what I consistently heard from this question is, it's an organization that has multiple different contracts, even sometimes multiple different IRCC contracts. Mm-hmm. And so how can you manage all of these contracts? Is there some best practice or recommendation to ensure compliance with all of them?
Yeah, great question. And this can get really complicated. So first of all, we recommend that organizations make sure that their accounting systems are capable of and set up properly to track the revenues and expenses related to each of the funder contracts. We work with organizations that have anywhere from 1 to 2 funding contracts. I think we've got one organization that we work with that has over 100 funding contracts on an annual basis. Now, usually one of the controller or finance director will work in partnership with the program managers who are responsible for delivering on the contracts to make sure that they have appropriate systems in place to be able to project manage the contract and to track and report on the financial spending and revenues. So this is really a significant role for your finance team to work with the program managers to make sure that you've got appropriate systems, like if you're using QuickBooks or Sage 50, setting up different departments for each funding contract, or setting up in QuickBooks using customers and jobs for each funding contract. You can make sure that you're tracking all of the expenses related to each individual contract. And it also means that your finance director or controller actually needs to read and be responsible for understanding the eligible and ineligible expenses, to provide a level of review of the program manager's work, and to make sure that the spending is in compliance with budget. So again, the finance director or controller working directly with the program managers. It's a significant undertaking to make sure that you're going to be compliant with the contracts, and it can be complex, and it requires an investment of time, energy, skill, expertise, and contract understanding. So I don't know if that answers the question, but it's vitally important for organizations to maintain good relationships with funders. And I think there's some organizations that don't invest well, and as a result, develop poor relationships with funders, and are likely maybe not eligible for future funding contracts because they're not putting enough energy and intention into complying with the contracts.
Perfect. Thank you so much, Gordon. There was a question came in the chat. You mentioned an organization in your previous response that provided some training around project management. If you could share that again.
Yeah, the organization's called Humentum. years ago used to be called Mango, and then they changed their name to Humentum. They are a global NGO training organization that provides training on a wide variety of topics to global NGOs. And some of their programs, well, all of the programs I've taken from them have been excellent. And in fact, we've had our entire staff take their budgeting program, which I would highly recommend for anybody, any program managers that are required to prepare budgets for their programs, as well as I'm pretty sure they offer a course called essentially Project Management for Program Managers. The quality of the courses I've seen so far has been excellent. So I'd encourage people to take a look through their catalog of courses and recommend those courses to any of their management team that they would be relevant for.
Yeah, perfect. Thank you so much, Gordon. And we can also get the link from you for the organization and share that out when we send out the evaluation, et cetera, from this workshop today. So I think that we're at the end of the questions that I've received so far that are specific around the first part of the content. So I'll hand it back over to you, and then please do share any of questions that may come through, and then we'll look for the next Q&A session.
Sounds great. Thanks, Sabrina. Okay, so now we're going to be moving into compliance with regulators, including the Canada Revenue Agency. And as I mentioned in the presentation on Tuesday, just a reminder that societies and nonprofit organizations can be incorporated either provincially or federally. I think about 80% of organizations roughly are incorporated provincially, and somewhere between 10 and 20% are incorporated federally. And that the incorporation legislation varies significantly by jurisdiction. So it's really important to have someone in your organization that has reviewed the incorporation legislation for your jurisdiction of incorporation, because there's a number of different items that vary. For example, in BC, no organization, no society under the BC Societies Act is required to have an audit. Whereas in Ontario or under the Federal Nonprofit Corporations Act, there's specific guidance about when you're required to have a review engagement, when you're required to have an audit. So that's just one example between two provinces. Fundraising is also different between the various jurisdictions. Your ability to operate a business or earn a profit can be different between the various jurisdictions. And what kind of payments you can make to directors is different in different, jurisdictions. So make sure that you've had somebody in your organization read the legislation for your incorporation jurisdiction and probably reread it on a regular basis so they're up to speed and aware of it. We actually provide, in most of the organizations that I'm on the board of, we provide a copy of the incorporation legislation or a link to it in our director orientation program, so that all of the directors have an understanding of what the rules are. And also, as we mentioned, the Canada Revenue Agency classifies social purpose organizations as either nonprofit organizations or registered charities. You can't be both at the same time. And if you're a nonprofit organization working on charitable activities, they will actually reclassify you as a registered charity. There is an application process you have to go through to become a registered charity, and there's pros and cons to that. It's a little more work because there's more regulation around registered charities, but you can also, as a registered charity, issue income tax receipts and receive funding from other registered charities. But note that from a terminology point of view, CPA Canada, if you're looking at audited financial statements, treats organizations who are classified by the CRA as not-for-profit organizations and charities identically. The rules for audited financial statements are identical for not-for-profit organizations and charities, whereas they're different under the Income Tax Act. Now, for registered charities, they've got a few required filings. First of all, they follow the same rules for payroll remittances and sales tax returns, both PST or provincial sales tax and GST. They're required to file a T3010 registered charity information return. And interestingly, when you look at the numbers, roughly half of registered charities who have their charitable status revoked have it revoked because they failed to file their T3010 registered charity return on time. The CRA has generally been fairly lenient around this, but has been cracking down recently. They've started reminding organizations to file the T3010 on time, and we expect that increased vigilance to increase over time. So it's critical that your organization file the T3010 within 6 months of your fiscal year end. And even though the T3010 includes information with respect to your directors, it does not update the list of directors that can talk to the CRA on behalf of your organization. And the CRA has a requirement that you're required to notify them whenever there is a change in directors. You're usually required to notify them in writing, typically by letter, and enclose a copy of the annual report from your that you file with respect to your legal status every year in your jurisdiction of incorporation. So really important to file that change of directors in addition to your registered charity information return. And this isn't there's a schedule 1262 or something. It's not that. It's not the schedule that's part of the registered charity information return. This is separate. You're required to notify them of change in directors. And we see many organizations who forget to do this part, and it ends up that nobody in the organization is authorized to talk to the CRA about the organization's affairs. So really important to keep that list of directors up to date. And also to, and the directors can authorize other people to talk to the CRA, like the executive director or the finance director. But you want to make sure that your list of directors is up to date so that there are some people that are authorized to talk to the CRA on your organization's behalf. And some registered charities aren't aware of this. But if you don't file your completed T3010 registered charity information return, you can lose your registered status, which means you're no longer exempt from tax. You can no longer issue official donation receipts. And there's actually a thing called a revocation tax, which is you're required to transfer 100% of your property to another qualified donee or face the 100% revocation tax, where you need to contribute all of your cash and assets to the Canada Revenue Agency. So you want to make sure that you maintain your status, because this is another one of those instances where the CRA walks softly but carries a big stick. If they do revoke your status, you lose 100% of your assets, and that can include land and buildings and investments and your bank accounts and everything. So really critical that you figure out a system to stay on top of your reporting requirements. There's a program called the Charities Education Program, and this is a voluntary thing where you can request that the CRA come out and essentially do a little mini audit of your compliance with the rules and regulations about being a registered charity. Highly recommend it. It's a voluntary program, but they'll come out and, as I say, do this little mini audit and give you a report on what you're doing well, what opportunities there are for improvement, and this helps keep organizations in alignment with the CRA rules and regulations. We note here that between 2018 to 2019 and 2019 to 2020, there were 6,500 charities contacted to file their T3010 on time, and 2,800 charities were contacted to improve the T3010 accuracy. And this is out of about 85 or 86,000 registered charities. And here's what I mentioned. I could only find data going back to 2015 or 2016, but at that time, of the 1,429 charitable revocations that were done in that year, 701 were voluntary. So organizations applied for charitable status revocation. Of the remaining 728, 20 were revoked as a result of a CRA audit, and the remaining 708 were revoked for failure to file their T3010 tax return. Now, there are a number of restricted activities that registered charities are required to understand and know about. So again, somebody in your organization should be making sure that they understand the restricted activities and make sure that they ensure that the organization stays in compliance with the CRA guidelines and policies. With political activities, this changed within the last couple of years. It used to be that only 10% of the organization's assets were able to be expended upon political activities. That requirement has essentially gone away. That limitation is no longer there. You can, in theory, spend an unlimited amount on what they call public dialogue and development activities, but there's still a restriction that registered charities are not allowed to spend any money or any effort on partisan political activities. Really important that you're not supporting an individual candidate in any municipal, provincial, or federal election, and that you're not supporting any individual political party. So long as that's true, so long as you're advocating for change in policy to serve the communities that you serve, you can potentially spend 100% of your funding on that now. The 10% restriction is not there. There's also a restriction with respect to unrelated business activities. And the CRA differentiates between related and unrelated. You know, related activities would be things like a church renting out, you know, part of its facility for after-school activities. That would be considered a related business because it's utilizing existing church assets. But if the church started a business where they were, I don't know, selling retail goods, that might not be a related business, and as a result, it would be prohibited, and the organization could get in some significant trouble. So you want to make sure if you're operating a business that it's considered a related business. Really important. The CRA has some wonderful guidance on fundraising activities on their website. One of the best pieces of guidance I've seen out of the CRA. It goes into significant amount of detail. You get really clear on what the limitations are around fundraising activities, what you're permitted to do, what you're not permitted to do, and what the boundaries are with respect to acceptable activities. So I highly recommend that for download and reading. The CRA does keep an eye on management and administrative activities. There's a specific line on the T3010 where you're supposed to report your management and administration activities. And for most organizations, this should probably be in the neighborhood of, you know, 20 to 30% would be an approximate range that would allow an organization to maintain sustainability. If organizations are spending less than 10 or 20% on management and administration, they're probably not sustainable. And if they're spending more, it may cause the CRA or funders concern. And different organizations have different needs for management and administration activities. There's an interesting study done in the US a couple of years ago that came to the conclusion that, interestingly, organizations that were growing in the US, there was a direct correlation with organizations that were spending between 30 and 50% on their management and administration and capacity building. But this is an activity that the CRA does pay attention to and funders do pay attention to. So we're working with an organization the other day that showed that they had management and administration expenses on their T3010 of 3%. And if I were a funder, that would cause me concern because it says the organization's not investing in its sustainability. There's also some great guidance on working with, the CRA calls them intermediaries, but this is really where you outsource some of your activities to nonprofit organizations or for-profit organizations. but specifically if you're outsourcing any of your program activities, the CRA has very specific limitations because those other entities haven't gone through the review and check that the CRA puts you through when you become a registered charity. And so they want to make sure that you're playing by the rules. Just like IRCC, they require you to have a legal contract in place that makes sure that those organizations are committing to playing by the CRA rules. You want to be dotting your I's and crossing your T's. Again, this is really important. And they actually have separate guidance for whether your organization's working, whether the intermediary is working within Canada or outside of Canada. Those rules don't apply if you're working with another registered charity, another charity that's registered and has status in Canada, but they do apply if you're working with an organization that doesn't. In addition to the CRA regulations, there's also the Employment Standards Act that you need to maintain compliance with. Really important that you're following the rules with respect to vacation entitlement, overtime. There's a number of very specific employment standards. These are typically provincial standards. So again, somebody in your organization needs to be familiar with the Employment Standards Act. There's also the Human Rights Code. There's a Proceeds of Crime and Terrorist Financing Act that you want to be staying in compliance with. And relatively new is the Lobbying Act. Again, somebody in your organization needs to be familiar with these acts to make sure that your organization is staying in compliance. Now, for organizations that are not registered charities, all corporations, and this includes societies, cooperatives, basically any incorporated entity except registered charities, are required to file, in addition to the payroll remittances and sales tax returns, they're required to file a T2 corporation income tax return along with any associated provincial returns. And this is something that many organizations aren't aware of. So virtually all nonprofit organizations are required to file T2 corporation income tax returns, and many organizations haven't done that for many years. And so you may want to start filing those returns, and you may need to catch up on previous returns by going through something called a voluntary compliance process, where you can you can get agreement from the CRA not to penalize you for not having filed your previous year's returns. You'll want to talk to your accountant or auditor about that if you haven't been filing your T2 corporation income tax return. In addition to the T2 corporation income tax return, nonprofit organizations are also required to file a T1044 nonprofit organization information return. This is, I think, if you have assets over $200,000, if you have essentially investment income over about $10,000, or if you've ever previously been required to file the T1044. And also, if your main activity is recreation or dining, you may also be required to file, and that would cover organizations like golf courses or some other kind of sporting organizations. Your T3 trust income tax and information return may also be required. Also note, just like with registered charities, you're required to notify the CRA of any change in directors, and usually you're required, as I say, to provide a copy of the annual report required for your jurisdiction of incorporation. And those are typically due on an annual basis. Ideally, you want to be notifying the CRA whenever there's a change of directors on an ongoing and timely basis. And there is, again, that's separate from any reporting you're required to do under the T2 corporation income tax return. So for the registered charities on the line, they can issue donation receipts for gifts of property from a donor. There's Mark Bloomberg, who runs a law firm in, I think, Toronto, has some great training available on official donation receipts. I'd encourage everybody to take a look at that if they'd like more information. But at a very high level, charities are eligible to provide donation receipts for cash gifts and gifts of property from a donor. But the maximum amount they're allowed to issue the donation receipt for is the fair market value of the property. And if the cash gifts are, if the non-cash gifts have a value exceeding $1,000, the CRA generally prefers to have an independent valuator provide a valuation. If it's under $1,000, the organization can do it itself if it has somebody that has that expertise. But for gifts over $1,000, they'd prefer an independent valuator. I also note that there's some things that you can't issue donation receipts for. First one is gifts of services. You are not allowed to issue donation receipts for gifts of services, only cash and property. If you need to for some reason, if somebody wants to donate some services to you, you can issue a receipt if you do a check swap. So in a check swap case, this would be where the organization, for example, a marketing firm wants to donate some marketing services. They would invoice you for the services, you would pay them for the invoice, and then they would use the funds to make a cash donation to the organization, and you can issue a tax receipt for a cash donation. So that's the way to do it if your vendor absolutely wants an income tax receipt. You are not allowed to issue donation receipts in exchange for advertising and sponsorship or for loans of property. So you want to be really careful. There's things like cause marketing, where an organization donates a percentage of the funds they receive in association with a particular organization. That's going to have a benefit to the organization from an advertising perspective. And if you can't quantify that, you really can't issue a receipt for it. So you want to be really careful about that. And the final one is loans of property. Things like, if you're doing an auction of gifts from different businesses, we've seen organizations try and issue donation receipts for rental of a timeshare or a condo or a hotel room. Those are all considered to be loans of property, and you're not allowed to issue donation receipts for those. So typical non-compliance issues for registered charities, this concept of lending registration numbers. And this is, for example, a nonprofit organization comes to a registered charity and says, hey, we've got a donor that has $100,000 that wants to give it to us, but they want a donation receipt. We can't provide it to them. Would you mind if he wrote the check to you? You could issue a donation receipt, and then you could give us the $100,000. That's what the CRA refers to as lending registration numbers. Again, this is exactly the concept of working with intermediaries, and you want to make sure you follow the guidance. And with the way the rules stand today, you're required to maintain direction and control over those funds. Direction and control has a specific meaning to the CRA, so you want to have somebody in your organization that knows what that means. They are in the process of reviewing the idea of direction and control. There have been some recommendations made to the CRA that they do away with that requirement or lessen the impact of that requirement, and they're looking at that, but for the current time, it's still in place. Another non-compliance area is inadequate books and records. The CRA needs to be able to conduct an audit, so you need to have adequate books and records for them to enable them to be able to do an auditor review. The biggest singular problem is with inflated receipt amounts. And we've seen some organizations try and issue receipt amounts for gifts that they receive in excess of fair market value. The CRA takes a very dim view of that and will likely not be very happy if that's something your organization is doing, and they may revoke your charitable status as a result. Also, income tax receipts have very specific requirements for completing them. You'll want to make sure that you're in compliance with the rules. So make sure that you have a copy of their requirements, and the person who's issuing receipts for your organization is familiar with the rules and is making sure that all of the required information is on your income tax receipt. The CRA periodically finds tax shelter gifting arrangements, and those are absolutely against the rules. So presumably none of you are doing that. And again, the CRA walking softly and carrying a big stick. They mostly work toward education with registered charities and how to get back on track and how to get back into compliance. But at the end of the day, they also hold a big stick and they can revoke your registered charity status, which can result in that 100% revocation tax that we already talked about. Okay, does anybody have any questions with respect to the content that we just covered?
Hi, Gordon. So I did receive a few questions. And one of them was a little bit as a follow-up to when you shared earlier around some training. They were wondering if there's any specific training that you know of that's related to the controller role.
Oh, great question. There is some training, actually. The various provincial institutes, the CPA institutes, typically have courses. I know in BC here, we have there's at least 2 courses that are available at different times in the year to enhance and build the skills for controllership. They also have courses on enhancing and building skills as chief financial officers. So I'd look to your provincial CPA institutes. Will typically have a significant volume of courses that are relevant for controllers and CFOs in industry and specifically in the nonprofit sector. They've got a number of courses around the skills required for individuals working in the nonprofit sector. So those are the only courses I'm familiar with that would be relevant for controllers and CFOs.
Perfect. Thank you so much. And the next question is, this individual is also wondering about social enterprise opportunities and how this would connect with some of the content that you've shared.
Yeah, great question. This is a really interesting challenge today because the CRA doesn't have specific rules today for social enterprises. Their rules are around for-profit organizations, nonprofit organizations, registered charities, and well, those 3 are the primary ones. And so if you're starting a social enterprise, you'll probably want to be talking to a charities lawyer, somebody intimately familiar with the charities rules. And they may recommend that you start a new corporation, either a society or a for-profit organization. But there are interesting restrictions. You know, for example, for for-profit organizations, in order to be deductible as an expense, your expenses are required to be spent to earn income. Well, what if you incorporate as a for-profit organization because you're going to make some money, but you have a community engagement or advocacy role? Can you deduct those expenses related to community engagement and advocacy? There's a question about that in my mind today. And there are relatively few accountants and tax specialists that understand the rules around social enterprises, because they're typically, there isn't a lot of training available because I think the CRA is unclear as to how they're going to be assessing these in a large part. So really important to get good advice if you're starting a social enterprise, and certainly complex organizations with multiple legal entities are becoming more and more popular as organizations start social enterprises. Often you may want to have a separate legal entity for each social enterprise to keep the risk separate from the organization. And as I say, there are charities lawyers that deal with these on an ongoing basis that can help guide you to how to stay in compliance with the Canada Revenue Agency's rules. Sorry, I'll just add to that, Sabrina. There's also some new specific incorporation rules for organizations that have a social purpose. So in BC, there's the C3 legislation that enables you, and these are for community contribution companies. And there's also something relatively new. There's legislation that allows you to incorporate as a benefit corporation, which means you have to provide an annual report that talks about the social benefit that your organization creates. So it's worth doing a little research and talking to a charities lawyer if you are thinking about or have already started a social enterprise.
Yeah, thank you so much, Gordon. That is quite a complex topic there. The last question that I've received, and I just wanted to see if there's any other questions that anyone has for Gordon, um, is around, you mentioned a charity education program.
Yes.
In yours, how do you sign up for that? And is there a cost for organizations, or is there a penalty, if the CRA does see anything that is negative? Just wanting to see how that would work and how that would impact the organization.
Yeah, so to the best of my knowledge, there's no cost to the program. You can sign up either through the CRA website or just give them a call. It's a voluntary program, but I highly recommend it to organizations that are curious whether they're currently abiding with the CRA rules. I have never seen any negative consequences come from these CEPs. As I say, I think the CRA views its primary role as trying to support organizations in staying in compliance with the CRA rules. So, I'm going to say, and I can't remember the exact numbers, but probably the result of 80% of the audits, and this isn't the CEP program, this is the actual audits the CRA performs, result in education and suggestions in how to get into compliance. So I think the CEP program is a wonderful addition, and I would encourage any organization that's interested in inviting the CRA in, because they're going to be able to they'll recognize that you take compliance seriously. You want to know if you're doing anything wrong so that you can get back in compliance and stay in compliance. So I think it's a great program, and I would encourage any organization that's interested to take the program.
Perfect. Thank you so much, Gordon. So I'm not seeing any more questions. I think maybe we can continue with the content, and if any more questions show up, we'll answer them in the next section.
Wonderful. Thanks, Sabrina. So I've got 2 or 3 or 4 more sections. We're going to talk about provincial sales tax. We're going to talk about GST. We'll talk about the public service bodies rebate. And I think there's one more section after that. With respect to provincial sales tax, and I'm just going to use BC as an example. In BC, PST, provincial sales tax, is charged on most goods and some services, notably legal services. There's a small supplier rule for gross sales under $10,000. But if you sell more than $10,000 in goods a year, you're probably required to register for PST in the province of BC. It's charged on the selling price prior to GST, and charities and nonprofits are required to charge PST if they sell new, used, or donated items, even if the funds are used for charitable purposes. But there are some notable items that are tax exempt. One is used clothing and used shoes sold for under $100, children's clothing and shoes, and qualifying books and magazines. And there's a couple of resources here if you're interested to find out more about provincial sales tax. And also note that if you have an auction where you are auctioning off alcohol, you are required to collect PST on that. That's a requirement. And there's a specific bulletin here for clubs, thrift stores, and societies and charities. I'd encourage, if you're running any of those, I'd highly encourage you to take a read through that document. Okay, now let's get into let's get into GST and HST for charities and nonprofits. The rules are different than for-profit organizations. So for for-profit organizations, you're required to register for GST if you sell taxable supplies in excess of $50,000 in the previous year, in excess of $30,000 in the previous year. For registered charities and nonprofit organizations, that threshold is $50,000. In addition, there's another exception for charities and organizations in the MUSH sector, which I think is municipalities, universities, schools, and hospitals, but not for nonprofit organizations. If total revenues, including grants and donations, do not exceed $250,000 in the current or either of the 2 preceding years, you're still not required to register for GST. And it's optional to voluntarily register below those thresholds. you probably want to be talking to your accountant as to whether there's a benefit for registration for your organization. And this is one where we've seen a number of registered charities not know that there is an entirely different calculation of GST. If you're required to register for GST and collect GST on your products or services, then the way it works for registered charities by default is that you remit 60% of what you collect to the CRA. That's it. There's very few ITCs that are available, that you're available to claim, and you collect, let's say, $100 in GST, you're required to remit 60% of it to the government. You want to show, there are a few very limited ITCs that you can claim, but they're very few and won't impact most organizations. There are also rules that allow certain charities to elect out of this calculation, but again, the rules are very strict and very few organizations have the ability to elect out. So for the vast majority of registered charities, if you're required to register for GST, this is the way you calculate your tax. It's not like the typical nonprofit organization or for-profit organization where you collect $100 in GST, but you pay, $30 in GST. You can deduct the $30 you paid in ITCs from the $100 that you collected and remit $70 to the CRA. That's not the way the calculation works for charities. So you want to make sure that your charity is following the net tax method in remitting GST to the CRA. Here's some additional reading if you're interested in those calculations. Okay, so are there any questions specifically related to sales taxes and charities and nonprofit organizations? And we're going to get into the public service bodies rebate in a few minutes.
Perfect. Thank you so much. Gordon, you did mention ITC. If you could just spell out what that acronym stands for, there was a little bit of confusion.
Oh, sorry, ITCs are input tax credits, and they're essentially the amount of GST that you pay on your purchases.
Perfect. Thank you. I just wanted to see if there's any other questions, because I did receive one of them. And this is really just around if you can explain what is the difference between a charity and a nonprofit when it comes to some of these reporting requirements in terms of tax.
There are a significant number of differences with respect to nonprofit organizations and charities. They're very different. The rules are different both for complying with the general CRA regulatory frameworks. They're also different with respect to sales taxes. They're different with respect to the public service bodies rebates. So I'm trying to identify those differences as we go through the individual sections to try and summarize them here. I don't think we have time, but certainly you'll all get a copy of the slides. And if you have any specific questions, you're welcome to shoot me an email or give me a call. Happy to try and answer them if I can. Now, I also want to point out that I am not a tax expert. I don't practice in the area of tax, either sales tax or income tax. So that the information that I'm presenting today is general information. It is not tax advice. If you have a specific situation you want addressed, you should contact a tax specialist and get specific direct advice.
Okay, thank you so much, Gordon. And the individual messaged me and clarified a little bit more their question. And it's in relation to that donation receipt that you said. They're working in a nonprofit and they often receive donations that is meant to be for clients, such as, for example, for Afghan refugees arriving, that they're receiving, clothing, etc. And so they're wondering if, as a nonprofit, if they can issue a donation receipt or what is their status in terms of that?
Yep. So generally not. There are a very few limited instances specifically for, what's an example? Canadian athletic associations that are nonprofit organizations can also issue income tax receipts. But I think that's one of the, I think there's one of 2 or 3 types of organizations, types of nonprofit organizations that are specifically allowed to issue income tax receipts. But by far the vast majority of nonprofits are not eligible to issue income tax receipts. And so they can accept the donations, but they want to make it clear both on their website and in any marketing information that they are not allowed to issue income tax receipts. And interestingly, by the way, the research that has been done suggests that most donors don't really care about the income tax receipts. So we've worked with a number of clients that are nonprofit organizations that request donations and regularly receive donations, but are ineligible to issue income tax receipts.
Okay, thank you so much for clarifying that. I think that was really helpful for the individual. So I'm not seeing any other questions, so maybe we can continue and we'll loop back in if there's other questions after.
Wonderful. So with respect to the public service bodies rebate, and this is separate from registering for GST. So even if you don't have any taxable supplies, you're not providing taxable goods and services, you're not required to register for the GST, all registered charities and some not-for-profit organizations are eligible to claim a public service bodies rebate. And here are the rates that you're allowed to claim. So for example, here a registered charity is able to claim 50% in most of the federal portion of the HST, and mostly 50%, but some much higher, 82% in Ontario and 35% in PEI, in a public service bodies rebate. So this is essentially claiming a percentage of the input of the GST that you've paid on your purchases, and you get a refund from the Canada Revenue Agency, completely separate from being registered to collect GST and HST. But this is a great source of cash for all registered charities and for nonprofit organizations that generate more than 40% of their revenue from government. So I've just got a couple of slides on whether or not you're eligible to claim ITCs and whether or not you're eligible to claim the PSB rebate. And it depends whether you're a qualifying nonprofit organization. And again, qualifying means you meet certain criteria, but generally it's that you're generating more than 40% of your funding from government. And if you're a non-qualifying nonprofit, you can still claim ITCs, but you're not eligible to claim the rebate. And the same, we've got the small supplier rules built into that as well. Registered charities are always eligible to claim the PSB rebate, but they may or may not be eligible to claim ITCs. And even in fact, if they are eligible to claim ITCs, they're very, very limited. They would be very, very limited. So again, with registered charities who are following the net tax method, there's very little by way of ITCs to claim. So you're mostly going to be relying on the public service bodies rebate. But if you're a nonprofit organization, you can claim the public service bodies rebate for any ITCs that you weren't able to claim generally. Again, for registered charities, this is very simple. You don't need to allocate any of your ITCs because you're generally not claiming them. You're following the net tax method. But if you are a nonprofit, a qualifying nonprofit organization, a qualifying nonprofit or a traditional nonprofit, if you're providing primarily taxable activities, so that 90% of your activities are taxable, then you can claim 100% ITCs. If you're primarily exempt activities, more than 90% of your activities are exempt, then you can claim no ITCs. And if it's somewhere in the middle, you can allocate your ITCs and claim them on your GST tax return. And potentially get a GST or HST rebate on the ITCs not claimed. I also make a note that the quick method, and you can get a description of this on the CRA website, is also available for qualifying nonprofit organizations. Any questions with respect to the public service bodies rebate?
Yes, there was one question, Gordon, that I've seen so far. You mentioned that you're eligible if you receive 40% or more from government funding. Does it matter if it's provincial, municipal, or federal government funding?
I don't believe so, but honestly, I can't remember off the top of my head. It's been a while since I've looked at that. So absolutely worth checking out. I think it's just government, which means municipal, provincial, and federal, but worth checking out there. And there is good documentation on the CRA website with respect to that.
Perfect. Thank you so much. And then the second question that's popped in is there a time limit or a certain time frame for making these claims?
Yeah, great question. There is for the public service body rebate, there is a 4-year limit. So if you don't claim it within 4 years, it falls off the table and you're not able to claim it. Generally speaking, it depends whether you're claiming frequency. It depends on whether you're registered to collect GST, in which case, oh, no, I can't even remember now. Generally speaking, you claim the PSB rebates twice a year, but it may be more frequent if you're registered for GST. You may have to follow your GST schedule as well, but generally twice a year. So your year's divided in 2, you claim you would submit a claim typically for the first 6 months of your fiscal year within, I think, 90 days within 6 months, 90 days or 6 months, can't remember. And then also submit a claim for the second half of the year. So it's usually twice a year, but if you're late, the CRA doesn't really care so long as you're not more than 4 years late. They put the 4-year time frame on it. So you can't claim after 4 years.
Perfect. Thank you so much for clarifying. So I don't see any other questions at the moment. So maybe we'll continue with the content and see if anything else shows up.
Sounds great. Thank you. So now we're getting into payroll. Now, this is one of the singular biggest financial risks that charities and not-for-profit organizations face. Charities and not-for-profit organizations aren't required to pay income tax, generally, and many aren't required to pay sales tax, but to the extent that you have employees, you are required to make appropriate remittances. And many organizations aren't familiar with the difference between employees and independent contractors. There is a significant risk to your organization if you hire people as independent contractors that should have been treated as employees, because the CRA wants to make sure that they're receiving regular income tax remittances and remittances of a Canada Pension Plan and employment insurance. So the CRA generally tries to treat everybody or prefer that everybody be classified as an employee when you hire them. But obviously there are some true independent contractors. If you're hiring a plumbing company to come and do some work on your kitchen sink, they're likely an independent contractor. If you hire somebody to do provide any kind of services, so long as they are truly an independent business and they're incorporated and they work with all kinds of clients and they advertise in the yellow pages and they registered for WCB and they issue invoices and it's a real company, then that's fine. But there's a gray area when some people who would normally be classified employees have come to the conclusion that there are tax advantages to be treated as an independent contractor. So individuals will ask you to hire them as an independent contractor and have them submit invoices on a regular basis, and you just pay the invoices without having to make payroll remittances to the CRA, and know that this is where organizations can get into real trouble, because a payroll audit, if done, we had one organization that had 20 people working for them, and they were all hired as independent contractors, when most of them should have been hired as employees with appropriate remittances made to the CRA. And a payroll audit like this can literally put an organization out of business, because the taxes and the interest and penalties are often as high as the reassessments, and they can go back years potentially if you're found to be negligent on this. and the organization can be held liable for making the payments regardless of whether they've been paid by the person who was hired as an independent contractor. So it's a serious risk. Organizations need to take adequate precautions to make sure that they're not artificially hiring these people as independent contractors when they really should be treated as employees. There's a great resource on the CRA website called Employee or Self-Employed. I would encourage all organizations to have a copy of this at the ready and to understand the rules before they hire people. It tells you who needs to be treated as an employee and who can be treated as an independent contractor. The courts have 4 tests established historically: control, the level of control, the level of integration, the ownership of tools, and the chance of profit or the risk of loss. Some judges take into account the intention of the parties. There's a good article from McCarthy Tetro there. There's a link in the slides. This is just such an important issue because I've seen organizations get huge reassessments that can literally put them out of business. So really important that all organizations protect themselves here. And some people think about the term casual labor, where they just pay people in cash. Well, that's not an option from the CRA's perspective. There's no such thing as casual labor. There's either employees, independent contractors, and independent contractors, as I say, have an established business, typically many clients, provides their own equipment, provides evidence of workers' compensation coverage, issues invoices, charges sales tax, is usually incorporated. And then there's volunteers that typically don't receive any money except for either reimbursements of expenses or honorariums of up to $500, which are typically non-taxable. But this category of casual labor doesn't really exist. So again, be really careful when you're hiring people to make sure that you're treating appropriate people as employees. If you do hire the independent, if you do hire individuals, particularly as independent contractors, there is a risk of reassessment. The CRA can go after income tax, CPP, and EI for up to 3 years or longer if you're found to be negligent. And as I mentioned, the penalties and interest can be significant. Now, here's something to know because it may modify your behavior. If you hire an individual who is an independent contractor that the CRA later comes back and says should have been treated as an employee, the payor bears all the risk. So if you're hiring an individual, Bob Smith, as an independent contractor, and they really should have been treated as an employee, you bear the risk. You bear the risk of reassessment. If you hire a corporation as an independent contractor, the contractor bears all the risk. So one of the pieces of advice that most tax experts will give to organizations is that if you're going to hire somebody as an independent contractor, make sure they're incorporated. If they're incorporated, you significantly reduce your risk. If they're not incorporated, you bear all the risk. So that's a really important, if somebody comes to you and says, hey, I see you posted this ad for an employee, I'd love to take it, but I want you to treat me as an independent contractor. And by the way, I'm not incorporated. I'd stay far away from that because you would bear all the risk. But if they come to you and say, hey, I'm a real business, I'm incorporated, I'd like to be hired as an independent contractor, that one would be okay to consider because the contractor at the end of the day is going to bear most of the risk for that. Whether you're hiring employees or independent contractors, you should always have a signed agreement. But if you're hiring independent contractors, you want to have ideally a competitive bidding process and a certificate of their workers' compensation insurance, because otherwise you're required to make WCB payments or workers' compensation payments on their behalf. And just a general rule, directors, officers, and senior staff are generally always treated as employees by the CRA, even if they're working part-time. I mentioned workers' compensation, and the rules vary. This is a provincial thing, so it varies by province, but they're generally payable on all employment expenses and payable on all contractor services unless proof of coverage is obtained. So this isn't just for employees, you've also got to look at your independent contractors. As I mentioned, the rules vary by province, and you need to sign up independently for the workers' compensation organization in your jurisdiction. If you're making payments to directors and volunteers, directors, again, you have to look to your incorporation legislation to find out, and potentially your bylaws to find out what kinds of payments you can make to directors. Typically, I think in all jurisdictions, you're allowed to reimburse any payments of business expenses by the directors. Directors' fees for acting in the capacity of a director are only allowed in certain jurisdictions, and directors' fees payments for other services to directors. In BC, I think the rules are you can pay them, but only if it's specifically allowed for in your bylaws. So you want to be really careful about making payments to directors. Payments to volunteers is generally considered business income. There's an exception for honorariums and gifts that meet certain criteria that are less than, in aggregate, $500 for a year. And this is different than the payroll rules for for-profit organizations and for employees. The honorariums and gifts can include cash and gift cards of up to $500. So that's different than the typical rules for employees. And let's see, I think that's it for payroll as well. So any questions on the payroll issues?
Yeah, thank you, Gordon. I think this is the sub area where we got the most questions, and so we have a few minutes, so we'll try and get through them as best we can. One question is around, the contractor, independent contractor, and what if in the contract letter it clearly specifies that this person is not an employee and that they're a contractor and responsible for filing their own taxes? Does that help mitigate the risk for the nonprofit?
So some judges take into account, if this goes to court, the CRA will generally may or may not take those letters into account. Some judges take into account the true intentions of the parties. Some don't. Sometimes, at the end of the day, for the most part, you should always have an independent contractor agreement in place. And if you are hiring somebody as an independent contractor, it should have all of those clauses. But more to the point, you want to make sure that the CRA has this same view that they would actually be an independent contractor. And you can get basically advanced assessments. There's a specific word for them. I can't remember off the top of my head, but you can actually submit a form and you fill it out and you talk about the circumstances and you think they're an independent contractor. You can file that form with the CRA and they'll actually give you a determination of whether that person should be treated as an employee or an independent contractor. But just having an agreement, if the person really should have been treated as an employee, is mostly irrelevant. So good to paper your agreements, whether they're with employees or independent contractors, good to include the right clauses, but the CRA and the courts are generally going to be looking at substance over form. So even if you provide all the right contracts, if the substance of the relationship is one of employee and employer, that's the way the CRA is going to try and assess it.
Thank you. And other question is, if a contractor receives less than $500 a year, should the organization still issue that T4A?
Yeah, great question. There's some very specific rules around the T4As. My understanding is, and this hasn't changed for a few years, that even though there is a requirement generally to file T4As for organizations that are paid more than $500, I don't believe you're required to file T4As for earning under $500. But frankly, my understanding is also today that if it's T4A for general business services, that you're not required, there's still a requirement to file, but the CRA is currently not penalizing anybody for not filing because they are aware that the current requirements are onerous. Technically, if you hired Home Depot to provide a service to clean your office, typically you're actually technically required today to issue a T4A to them and all other corporations that provide services. So I think they're in the process of reviewing the rules, and until they complete that review, they're not penalizing anybody, but there is still a requirement to file T4As. But as I say, there is a specific compliance policy in place now, and it would be worth checking the current status of that as you're determining whether you want to file the T4As.
Thank you so much, Gordon. So, there's one final question that's popped up, and I'll just maybe just ask you this one in regards to what if it's like a janitorial company as an example? Would you need to issue that T4A to them? I think that individuals is not quite clear following your previous answer.
Yep. So generally speaking, what the CRA is really concerned about and why they want organizations to file the T4As is specifically, I think what they're trying to catch is unincorporated individuals that should be paying taxes that are being paid in cash and aren't declaring it on their income tax returns. So, so I think if you're paying unincorporated individuals, I would generally want to file the T4As just to make sure that everybody's treated fairly and everybody's declaring the right amount of revenue. If they're incorporated, there are some big janitorial companies. If you're using a big janitorial company, I probably wouldn't worry about it. But if it's an unincorporated individual providing any services to your organization, I would want to be providing T4As.
Perfect. Thank you so much, Gordon. And so we've come to the end of our time. And so just wanted to say in closing, thank you so much, Gordon, for sharing all of your knowledge and insight during these two workshops. And we've just shared Gordon's information on the screen as well. So thank you so much. And I also just wanted to say thank you so much to our interpreters for interpreting today during the whole event, as well as to the AMSA team. I just wanted to say in closing, thank you so much. We will be sharing the PowerPoint slides with you. We did share them earlier this morning before the presentation, and there is a workbook that we will also be sharing with you, and both of them are going to be available in English and French, so we'll be sending out all of that. And so on the next slide, we just wanted to share how you can stay connected with the settlement integration sector. Sign up for AMSA's weekly newsletter, SetNet. This is also how we're going to be sharing when the recording for these two workshops are going to be live. So you can go to our website. And I just saw that my colleague posted the link in the chat as well to sign up and register. As well, just wanted to highlight how you can follow AMSA social media on the next slide. And just welcome and encourage you to follow us on Twitter, Facebook, and LinkedIn. We post about different events and different information there consistently. We will be sending out an evaluation form, and we'll just share that on the next slide. And so I just want to say thank you so much, and we welcome your feedback. It's very valuable to us, and so we're looking forward to collecting all of your information responses in that evaluation form. So just want to say thank you again, Gordon. Thank you to the interpreters, and thank you to the AMSA team, as well as to IRCC for supporting today's event and for attending. Thank you so much, everyone. Hope you have a great rest of your day. Bye-bye.
Thanks, everyone. Take care.